let's get started here. You guys probably got that I am the Irish English Sean Brown talking to the German Josh Brown. No relation. We're both equally good looking or equally bad looking, depending on how you want to look at it.
Yeah.
Um, we're here to discuss the hottest trends in wealth management that are shaping for 2025. Please feel free to use the Q&A with any questions. I will tell you, we're hoping to keep this interactive. We're going to have some polls coming up. I think we're going to have like 7 polls coming up to get your input on various things. But before we do that, I am compelled to tell you on behalf of both YCharts and the Ritholtz Group that this content is meant for educational purposes only. It's not intended to be investment advice, and we are not acting as investment advisors. I know Josh's firm sometimes does, YCharts does not. Um, we will be sharing this webinar with those who registered via email, and it will also be on ycharts.com and our YouTube channel. So it is there when you hear these wonderful nuggets that Josh is going to share with us, and you're like, I failed to write that down. Just know it's coming your way. It will be easily accessible.
Hey, Sean, one really easy way for the audience to tell whether or not me or anyone else is giving them investment advice, ask yourself this very simple question. Did you pay for it? Nobody, no one on this earth is giving free investment advice on a personalized basis to anyone who is not paying them for it. So always take anything you hear from any quote unquote expert, pundit, market commentator. Always understand they're stating their opinion, not telling you what to go out and do.
Yeah, and joke and serious. Um, make your own decisions. You will hear some opinions, and do with them as you will.
Yeah.
Josh, before we get going here, though, tell us a little bit about the book that you have out now. What's it all about?
Oh, cool. Well, this is the best. I think this is the best thing that I've ever written, and I've been writing semi-professionally slash professionally for about 15 years now. This book is the culmination of everything, every important takeaway that I've gained throughout the process of writing the Reformed Broker blog for as long as I did. I basically was doing daily market commentary and observations on the blog. There were some days where I wrote 4 or 5 times a day, and all of the really important stuff. And as you could tell from the title of the book, it's sort of revelatory because what I try to do is connect the headlines that you read or the television segments that you watched in real time with what was actually going on behind the scenes. And I'm pretty uniquely placed to have been able to do that. So that's the theme of the book, is that there's the game and then there's the game behind the game. And I think when you finish reading it, you'll become a better investor or have a better understanding of how things actually work and how the sausage gets made. So that was the intent of doing the book, and so far the feedback's been really good. So thank you guys for anyone who's bought it, commented on it, reviewed it. I appreciate it.
Yeah, and I am just thrilled. I've known Josh for years. Many of you know Josh from his CNBC appearances or his absolutely awesome podcast. Josh is also the CEO of Ritholtz Wealth, and it's been just awesome to watch every one of the facets that Josh has touched, including business, on air, everything, just absolutely turned to gold. And it's because Josh is a straight shooter, and he's able to tell his story in a very colorful and just candidly honest way. So, looking forward to getting your hot takes on several topics today, Josh.
And you will.
All right, so we're going to try to cover 4 key categories with a couple subcategories underneath each, aided by a picture. But I don't want to worry too much about the pictures in here, and make sure people are getting some hot takes on some concepts. So we're going to talk about personalization and portfolio management, macro trends for investment strategies, emerging trends, emerging markets, market opportunities, and then technology's role in wealth management. So let's dive into that first category. Um, Direct indexing, Josh. I think many people understand direct indexing as, hey, a way to invest in an index. in a tax efficient way and maybe a very personalized way. Um, what are your takes on direct indexing? And is this something that is an important investment vehicle for all classes of investors or just some?
Yeah, I think this is the current and future investing megatrend. I think it's more important than the now widespread embrace of alts. We can talk about alts later on. I just think this is bigger and this is more impactful for clients. It's probably not as big of a story in the media, and it's definitely not a bigger fee generator than the quote unquote alts revolution, which is probably why there's less fuss made over it. But in a very grassroots way, the advisors who are adopting this technology are absolutely in a slingshot situation relative to the rest of the industry. You can't if I talk to your client and I show them what I can do with a custom index, not just from a tax perspective, although that is nice. But if I get into the third or fourth conversation with your client's coming to us. Like that's it. And it's not our intention to take people's clients, but if you're doing, here's my 7 ETF portfolio, I rebalance twice a year, I reconstitute every January, and I write you quarterly investment letters. Like if that's what you're doing, you can't beat me. And so a lot of firms have adopted custom indexing because the ability to marry the holdings of a portfolio and the way it acts mechanically on a daily basis to the client's actual personal situation is incredibly powerful. And we can, get into the nitty gritty of why. I don't know how much time we have, but if this is not something you've looked into for your higher net worth clientele, I highly recommend that you make 2025 a year of discovery.
No, that's a great outtake. I think Emma, love to poll the audience here and just get a gauge for what people's perceptions of direct indexing. And I think the question that will be popping up is, as you can read, are direct indexing and custom indexing a service you market as a key offering at your advisory firm? Yes
Good
or no? And we'll give people just a few seconds to give an answer there, and we will pull up the results.
Sean, I'll say, yeah, that's about what I expected.
Yeah.
We'll do this poll next year. It'll look different. One of the things is, so there are these moments in the history of financial advice, wealth management. There are these moments where a new development happens, and sometimes it's a technological breakthrough. And so in this case, it's the timing of commission-free trading and the advent of the Canvas operating system, which we were one of the first firms to adopt. But there are these moments where it's like, okay, here's this new thing that comes along. Maybe it's regulatory, maybe it's technological, maybe it's cultural, but like there's like a dividing line. The firms that choose to make the investment in time, money, and energy to adopt or adapt to these new developments, and then the firms that are like, we don't need that, we'll skip that. And it's hard to know which is which because there are a lot of false versions of this.
Yeah.
I genuinely think there's a dividing line now, and it's going to get wider, and the cliff is going to get steeper. The firms that understand the power of custom tailoring the investment experience to their clients and the firms that don't. And it's not that you can't survive if you don't make it on that cliff jump. It's just making your life much harder because the client expectation amongst the investing public is going in one direction, and that is, don't give me a portfolio, give me my portfolio. And we see that in every other industry, so this is not terribly unique. Walk into a supermarket, tell me how many types of ketchup or mustard there are on the shelf. Everyone has their personalized version. So this is not going to go away. It's not going to get easier to compete with, and it's not going to be obvious to your clients why the firm down the street is able to do something and you're not.
Yep.
So I would just be thinking in that direction when it comes to custom indexing.
Yeah, I agree. And we're seeing a lot of our prospects and customers who are really diving into custom indexing, saying, hey, I know what the index looks like, but I already have 4% exposure in my portfolio to Tesla. So they're using our platform to help them see what that aggregate exposure is and then swap out.
Sean,
Hey,
let me let me let me jump in here. This is really important. I want to get very specific. Um, in 2023, the Russell 1000, which is all the U.S. large caps, the
mhm,
Russell 1000 was up 26%. However, 30% of the stocks in the Russell 1000 ended the year negative with a
mhm,
loss. That's tax alpha.
yep,
Okay. So if I can give you the return of the Russell 1000 in a bull market, which
yep,
again was about 26%, and I can harvest all the losses from the 1/3 of Russell names that were negative, if you can do that for 7, 8, and 9-figure accounts, you keep those accounts forever. And that's just a bull market scenario. The second thing, we have clients with, you're talking about 4% Tesla, fam. If somebody calls me up from California and says I have an $8 million net worth and 6 million is in Meta stock because I spent 9 years working there, I can't buy this person the cues.
yeah,
It's almost professional malpractice. So being able to build an index
yep,
approach, but subtracting out the exposures that are already this client's number one risk factor,
yep,
it it becomes very obvious. Now, here's the trick: you can't do this if you're not staffed up operationally.
yep,
So I mentioned Canvas. That's O'Shaughnessy Asset Management
mhm,
founded that technology and then sold to Franklin Templeton. My trading and operations team, they're on the phone like pretty much half the day with the trading and operations people at Canvas
mhm,
because of the amount of accounts we're onboarding and the amount of
yep,
like you need to be operationally staffed up to do this. This is not CFP work. And
yep,
that's why I think there's been this reluctance for a lot of RIAs, especially smaller RIAs, where the founder is wearing all the hats. It's
yep,
daunting, and that's why I call it a dividing line. It's been relatively easy to be $100 million RIA for the last 10 years. Like you
yep,
really have not been at a scale disadvantage to mid-size and large firms. This is one of those areas where the dividing line is going to make it tougher. So I understand the reluctance, the hesitancy. It's a lot of technology. It's a lot of moving parts.
mhm,
You can't screw it up. You can't mess up the allocation. So you need
yep,
dedicated people to do this right, and not everybody has them.
yep. Awesome. So we saw 40, 60, 60, 40. I can't remember what we just saw of people doing this. We're going to see a lot more in
I think you'll be
2025.
50-50 next year.
Yep. All right, let's switch to another topic, which is behavioral finance. This is just a picture to remind us all that, since 1990, there have been umpteen reasons why you should get out of the market and sell. Gulf oil spill, government shutdown, COVID cases, et cetera. That wouldn't have been a good move. You
Have
would
you
have
ever
missed.
seen Batnick's version of this chart?
No.
Our reasons to sell chart, it's 20 times more hilarious. We
Yeah.
put in things that people are embarrassed about now. Uh, Remember the yen carry trade like 3 weeks ago? And people,
Yeah.
people, we have stuff like that in ours. It's way more cluttered. Yours is nice though. I like
Yeah.
it.
But listen, it supports the thing I want to talk to you about, Josh, which is behavioral finance. And I think everybody's pretty attuned to what behavioral finance is, but it's recognizing that emotion and biases impact our investment behavior, recognizing those and trying to combat those. We see guys like Brian Portnoy out there doing some interesting things at Shaping Wealth, and Daniel Crosby at Orion espousing behavioral finance. I guess my question for you, Josh, is Is behavioral finance something that wealth advisors should be adopting as a way to speak about investing to their clients?
Um, I always say I'm not going to do this when I go on these things, but I'm going to do it. It's really easy for me to press publish on a blog post. It says la di da. Here's the returns of the market. Everything's going to be fine. Publish, then copy paste the URL, tweet it, LinkedIn. Look how great I am. It's really easy to give a webinar telling people everything will be fine, ignore the noise. It's so easy to publish a book, stand on a stage. The hardest thing in the world to do is the thing that all of the advisors who are joining us today are doing in real life, actually being in these meetings with people who are sitting in a 10 or 15% drawdown of the entirety of their retirement. I promise you, getting through that conversation and having the client leave that, whether it's a call or a meeting, feeling okay, that's the real work. Giving a speech at a conference or publishing a blog post, I don't care if you have a PhD, it's just not that impressive. So we have advisors that are in this thing with us right now who are doing very impressive hand-to-hand combat to get clients through these moments. And we can like look back on these things and mock them. Some of them were a really big deal. The Lehman Brothers, 9/11, pandemic. It's not that all of your clients at once wanted to sell. It's like you have that one client who is irate or terrified, and it's like so professionally important to not let that one person slip through the cracks and blow up their whole retirement. And that's the real work. And
Mhm.
so look, I post Ben Carlson stuff and Batnick stuff. Don't sell, don't sell, don't sell. Yeah, we look really smart. We've been saying this for 15 years on our blogs. Like we live this. So yes, of course, the S&P is up tenfold since the bottom in March of 2009. We look great. And there are some markets where we won't look so great. So people mocked us in 2022. Let me guess, 60-40? Yes, actually. Yes, actually. Can you give it a minute? Does it have to work every day for it to be effective? No. So I take this stuff really seriously, even though I make a lot of jokes about it, and I just want people to hear both sides of it directly from the horse's mouth.
Awesome. Hey, Emma, would you mind putting up a poll around behavioral finance? Let's just see what the audience is thinking about the future of BFI. Is behavioral finance coaching a practice that will be table stakes for advisors in the coming few years? Let's
Well,
take a.
of course, the answer is yes. Look, by the way, if we think portfolios have become commoditized, just in the sense of like everyone understands asset allocation, whether you're doing custom indexing or ETFs or mutual funds, the basic idea that different asset classes will have. Hey, look at this. Not surprised at all.
Wow. And I know Brian Portnoy is listening in. Brian, you have
Love
job
Brian.
security next year.
Yeah, man. Brian,
Uh,
this is Brian, this is a good sign for you. Look, I know that everyone understands asset allocation, so that stuff becomes commoditized. Here's the deal. Not every advisor has to agree with me or anyone else about like what percentage alts, active versus passive, international or US only. We could all have different opinions on that. But the one thing we have to agree on is that none of that matters if your client doesn't stick with the portfolio. Like
mhm.
whether you were active or passive is not going to help if the client sells out. So behavioral alpha, if you want to call it that, is the only thing. And then all of the other stuff that we have these like academic, endless circular debates about,
Mhm.
it almost is not relevant,
Mhm.
especially in terms of the end result to investors. So I like that 95%.
Yeah.
And I think the other 5% was probably just people goofing around. I don't really believe that there's any advisor who says,
Yeah.
I add no value on the behavioral side. I
Yeah.
highly doubt it.
They probably just hit the wrong button.
Yeah, they hit the wrong.
So Josh, I know you've been on air most of the day. Did you happen to notice the BlackRock acquisition that was announced?
Yeah, $12 billion for HPS. I think it's
Yeah.
their second big acquisition in the space. They
Yeah.
bought Prekin. Um, Look, this is not rocket science. On Wall Street, people don't sit in a room and say which products uh, would be the best products for our customers. They say, what can we sell? What are people willing to buy and pay for? And that's the products that come out. No disrespect intended. This is every industry. Um,
Hmm.
so when you think about it that way, investors over the last 10 years have definitively told Wall Street, stop making stock picking actively managed funds because we won't pay for them, with a
Hmm.
few glaring exceptions to what I've just said, like Cathie Wood springing up here and there. But for the most part, um, financial advisors are not going to recommend 1.5% fee active mutual funds to their clients for a whole host of reasons, including business model,
Hmm.
intermediary risk, et cetera. So the question is then, well, what will people pay 1.5% for? This is the answer.
Hmm.
Um, when you listen to the conference calls of these companies, and many of them are public companies, private equity, the bright spot is always wealth management. The future growth is always wealth management. It reminds me of listening to consumer staples companies' conference calls in the 90s and 2000s. The answer to everything was China.
Hmm.
Like, what's your growth strategy? China. So, all right, what's the growth strategy for KKR, Blackstone, Ares, Apollo, on and on and on and
Hmm.
on? The growth strategy is to get the wealth management channel to move from 0 to 5% allocation in alts to 20%, which is where they think ultimately it's headed. And maybe they'll be right. I doubt it. I do think it can go to 10%.
Hmm.
There's a ton of momentum here. There's a ton of enthusiasm, lots of excitement. And now I'm going to say the second controversial thing that I told myself I wouldn't say. You familiar with Sturgeon's Law?
No.
Okay. Sturgeon's Law is, for me, this is an iron law of the universe. Sturgeon was a science fiction writer, and in the 1950s, somebody interviewed him and asked him, why is there so much bad sci-fi being written? At the time, most popular form of entertainment was novels. Why
Hmm.
are there so many bad sci-fi novels? And he thought about it, and he said, there are no more bad sci-fi novels than there are bad everything else. It doesn't matter if it's movies, music, baseball players, law firms. So Sturgeon's Law became, and this is his quote, 90% of everything is shit. So no offense, if you are loading your clients up with 12 different
Hmm.
types of alts, most of them you're going to apologize for. And some
Yeah.
of them will earn the higher fees and possibly the higher volatility or the laundered volatility, as Cliff Asness would say. Some of them will earn their keep. Most
Hmm.
of them won't. And I'm really bullish on this because my firm will spend the next 10 or 20 years unwinding a lot of the disappointment as portfolios are transferred to us. So I am not anti-alt. In
Hmm.
fact, one of our one of the most popular strategies that we do is an in-house proprietary alt. We call it Goaltender. We use it to manage client behavior in statistical bear markets. We are pro-alt. We are anti-alt gold rush. And
Hmm.
we do not think a lot of the decisions being made right now will prove to have been wise decisions
Hmm.
in the next crisis when many of these strategies see their correlations with the public markets snap
Hmm.
to 1.0. No,
Yeah.
no one's going to be thrilled with that. So uh, I'm fine with alts.
Yeah.
I do think that there is a really good place for several alternative strategies in wealth management portfolios. I think
Hmm.
financial advisors should be well versed what they are, how they work, who they're appropriate for, how to evaluate them. All good. But I don't like anything that looks or smells like a gold rush, and that is
Hmm.
exactly what's happening today.
Yep. Emma, would you put up this poll? And while you are, Josh, thank you for Sturgeon's Law. My grandfather was Harvey. and my English Irish grandpa. And I think Harvey's law would be don't bet against BlackRock. So we just saw
Oh, they'll make
BlackRock
money.
yeah, Josh
wouldn't bet
mentioned the
against.
private credit seems to be a good one. Private equity hedge funds, but
Yes,
yeah.
everybody wins. It's all going to work out great.
Which alternative investment type do you think, audience, has the most potential for advisor uptake in the next decade? We're looking out many years, not just next quarter. Tell us what you have to say about this, gang.
I don't even have a guess. 80%. 80%. Oh, this isn't a percentage of the audience. This is pick one. Oh, I see. All right.
Private equity venture.
I think I would have said real estate higher.
Yeah. Well, it's interesting. Private debt was not on there. So people are betting against BlackRock.
I think people that wanted to say private credit probably just picked private equity because it's like
it's private. They're both
kind
private.
of a sister asset class, and a lot of the best private credit firms also are doing private equity. So I think that's probably the way people voted.
All right. Well, we're starting to see some consensus forming here. Let's talk a little bit. Shift focus now to the next big topic, which is macro trends. So, Josh, tell us a little bit about inflation. Just a couple slides for some context here. You know, we're all aware of what's happened with the inflation rate peaking, Bloomberg indices, and I'm going to just swap back and forth. You guys had an interesting visual that you put out, which was looking at inflation in the 2010s versus the 2020s. The light blue 2020s, higher and steeper in 5 years, more than eclipsed the prior decade. What should people be thinking about with regards to inflation?
Well, here's what I actually want to say. The 2010s were the aberration. So we get into the 2010s decade. We start off in the midst of what's known as a balance sheet recession. There's too much debt. The world is awash in debt, and therefore GDP growth remains challenged, and spending is low, and risk-taking is low, and capital formation is low. And of course, by 2019, that has corrected itself. But you basically have half of that decade substantially below the Fed's mandate of 2% inflation. You've got by the end of the decade, you've got $13 trillion in fixed income, global sovereign debt from all over the world, every continent that issues debt at a negative interest rate. So that dark blue line, we are not representing that's what inflation should be over the course of a decade. We just so happen to have had a financial crisis, a lot of repression on the financial repression on the part of central banks all over the world to try to fight higher unemployment and depressed real estate prices, and the net end result was low rates and low inflation. I'm not saying that the experience of the last 4 years is healthy either. I think what you'll probably see is that light blue line normalize and come closer to the navy line, but you won't know if I'm wrong about that for another 6 years. So hopefully, if I am, everybody here will forget.
Yeah. Hey, Josh, I'm not meaning to in any way get political here, but there's obviously a big debate going on right now. First of all, just the general
Hunter Biden.
No, not that one. Not that one.
Right.
And not the next six you're going to mention. The seventh one is tariffs.
Yeah.
And there's certainly a big misunderstanding among the general Americans about who pays for tariffs, et cetera. But I think most economists, are correctly stating this does create additional inflation. I guess I'd say
the consumer and the taxpayer pay for the tariffs, not the businesses in foreign countries, and therefore the foreign countries themselves also pay a price.
Yep.
It's one of the few things that's no win. So like most policy decisions have winners and losers, have pros and cons. So just look at the last round of tariffs. And I understand, look, not everything Trump says is wrong. And there is a lot of unfairness in terms of the way international trade goes. And we have made some decisions that ended up coming back to haunt us in the original iteration of NAFTA in the early 90s, which absolutely resulted in the outsourcing of a lot of American jobs into Latin America. Absolutely true. We absolutely made a miscalculation allowing China into the World Trade Organization without the restrictions that should have been there. Like we've made mistakes, every administration, Democrat, Republican. So not everything Trump says is wrong, but what he is absolutely wrong about, implemented tariffs 100% are inflationary and are not great for most businesses in America. Definitely not great for most consumers. So this is, nobody can deny, even the people he's hiring to represent him on economic matters, their spin is, oh, he's not really going to do them. What he's doing is he's threatening them as a way to conduct foreign policy. So here's an example. If Mexico doesn't close the border to illegal immigrants and fentanyl, we will slap 100% tariffs on Mexican imports. Okay, fine. So nobody is saying that's good for the economy. He's using that threat as a cudgel to get the Mexican government to do, whatever he wants to do. Fine. I totally understand it. That is what his people that he is now nominating to economic positions are explaining to the American public. Oh, don't worry. This is rhetoric. This is how he negotiates, blah, blah, blah. Okay. That may end up being true, but here's something else that's true. The agricultural warfare that China carried out in retaliation for the tariffs that we slapped on them was absolutely disastrous for the U.S. taxpayer because the farmers all over the Midwest, the upper Midwest, had to be bailed out by the Trump administration. It was a backdoor, but it cost taxpayers $28 billion in order to make the farmers whole who lost their biggest export market for soybeans and other commodities. So you don't have to take my word for it. I'm not a political person. I honestly don't even, I don't get upset in the presence of other people's political opinions. You shouldn't get upset by mine. I'm just stating the facts that everybody knows if they spend even 5 minutes looking into it. All of that is to say, we know what he's saying he's going to do, and we should take him seriously. We don't know specifically what he'll end up doing, and we should not take him literally. Let's see what happens.
Yeah.
Maybe the threat of these tariffs will have the impact that he wants them to have, and we all live happily ever after.
Yeah.
I'm willing to allow that that's possible.
Yeah. Well, let's agree that inflation is a topic that people are going to want to understand. I guess.
Now, Emma, about Hunter Biden.
No.
All right, I'm sorry.
Emma, would you put up the next poll? I think I'd like to understand if inflation is a topic. Does our audience foresee inflation hedge strategies as essential in today's market, and especially the market going into 2025? Is it important to just know about inflation, or is it important to be implementing inflation hedged strategies? Let's see what our audience has to say here. Okay. Yes and no.
Strategies essential. You know what? It's a flawed question because the best inflation hedge is U.S. stocks. So like everyone in this webinar is hedging against inflation by default if they're buying equities. Because equities do a better job than gold, do a better job than real estate, do a better job than private business ownership. There is no better inflation hedge than the U.S. stock market. And not just recently, which it is true, it has been, but over, 300 years.
Yep. Well, covered inflation. Let's talk a little bit about the Fed and interest rates. What should people be thinking about entering 2025? Obviously, everybody's followed the rate hikes and the slight rate cuts that we've seen and the impact on equities and other. What should people be thinking about?
Sean, last week the spread of corporate bonds to the same maturity Treasury hit a 17-year low. So there is currently almost no risk, economic risk being priced in the bond market right now. And I would tell you, until something blows up, the Fed is in this really interesting position where they can or cannot, if they so choose, do rate cuts of choice. It's a really interesting time. Most of the time, the Fed is under duress to be heading in one direction or the other. There are these periods of time where they almost like can say, 25? Let's do it next month if we need to. Like that's where we are. It's great. There's an equilibrium. There's plenty of demand in the economy. Labor force is in good shape. Home prices are back to breaking record highs. Not so great for the home buyer. Very good for the 65% or so of the country that owns their own home. Rental prices have cooled off. Jolts have cooled off, which means less pressure for employers to give raises. But anyone that wants to work is working for the most part, and the Fed is not really fighting a financial crisis anywhere. The bond market is placid. Stock market's okay. Not a lot of bankruptcies, not a lot of credit card delinquency, not a lot of auto loan charge-offs. So, like, that's the environment that we're in. I can't promise you it'll persist, but until something breaks, that's why credit spreads look the way they do. And I would also point out, this is a phenomenon we see all over the world. This is not a U.S. only. No, so a lot of international economies are not in as great of shape as we are. Obviously, it's been that way for a long time, but it's not as though there's some sort of financial crisis happening like across Europe or in Latin America, or it's the usual suspects. It's Venezuela. So we're in this moment where not just the Fed, but central banks around the world, they have like a choice, and it's an interesting thing to watch what they'll end up doing. But I don't think the Fed is the big story right now, quite frankly.
Yeah, interesting. And the word interesting is almost like, yeah, these are topics out there that are interesting, but are they important anymore? And I guess we'll have to see.
I don't know. So if you told me the Fed cuts in December or doesn't cut in December, I don't know which one is a bigger bull or bear catalyst. I could give you the narrative that we'll all say the next day,
yeah,
when the market moves. So if the Fed doesn't cut in December and the stock market rallies, everyone will say, see how great the economy is?
yeah.
Or the Fed doesn't cut in September, the Dow falls 600 points, me and all my TV friends are going to say, the Fed has made a policy error. So I really don't even know. Like that's how minimized the central bank story has become. And what's on the main stage at the moment is the extension of the Tax Cuts and Jobs Act and mass deregulation on a scale that we really haven't seen since the early 80s. Those are the two things that have people's attention, and not the next 25 basis point rate cut. And again, there is nothing in the economic data that seems to be pressuring the FOMC to do anything right now.
Yeah.
So I wouldn't say that's a negative. I would say it's kind of like, hey, nobody's paying attention to this because they don't feel like they need to.
Awesome. Let's move on. Emerging trends. So you started to hit on this a few minutes ago, but strange times where mortgage rates are down 13% from their high, but up 50% from their averages. And strangely, even though mortgage rates are up, housing affordability and home prices are up 60% in the last 5 years. What should people be thinking about the housing market as a double-edged sword and investing in real estate?
I don't look at owning your own home that you live in as an investment. I look at it as a form of consumption. I think it's the best form of consumption that exists. There's nothing wrong with renting. This is my personal opinion, not an economic opinion. I think having a place of your own that you own, that you take care of as if you own it, you're surrounded by neighbors who also own their property. You live in a neighborhood with high home ownership and people who are planning to raise their families there over the course of years and decades. Like, I think that's there's very little else you could spend money on that has the same emotional return on investment, even though it's not an investment. So all right, so that's my shtick, and I live in the same house since 2008. Um, from a economic perspective, I honestly think if Biden slash Harris had a plan, like a real plan for what
Mhm.
they're going to do about the housing affordability crisis, they wouldn't have lost as many young people, and they might have pulled out the election. So I know everyone, myself included, believes the election came down to out of control immigration, which it definitely did.
Mhm.
Um, censorship slash woke culture, 100%. That was a huge animating factor for what got people out. Um, and then the third thing is the state of the economy slash inflation.
Mhm.
And the Biden Harris camp, like they just missed this. I don't know who this guy. I don't like. I know who their economic advisors are. They didn't do their job. They didn't tell the story of wage growth and investment portfolio growth and all
Mhm.
the great things that took place over the last 4 years. And they ignored the fact
Mhm.
that millennials and very soon Gen Z are literally shrieking
Yeah.
at the impossibility of buying a single family, unattached, standalone house. And
Yep.
if you don't have wealthy parents, you literally can't. And that's a huge problem for our economy. It is absolutely holding back everyone, whether it
Yep.
affects you directly or not. And it's like they weren't even aware that this problem exists. Not that the Trump camp had anything to say about it either. It never came up, which is weird because 100% of Americans have one thing in common: they have to live somewhere. So I don't think this is going to get solved. I don't think Trump and deregulation can wave a wand and all of a sudden have Toll Brothers say we're going to build twice as many units as we built last year.
Yeah.
And absent an increase in supply, the affordability crisis ain't going to change. I don't care what you do with mortgage rates.
Yep.
It's not going to make a
Yep.
difference. So
Yeah.
it's tough. It's intractable. I don't have any answers either. I'm
Yeah.
just going to tell you, I think this is a permanent feature of the Roaring 2020s is a lack of affordable housing.
Yep. Yeah. It's just such a strange dynamic that these two aren't the inverse relationship of each other. When interest rates go up, housing prices go down, which your college finance courses would tell you is the
Not if
case.
nobody needs
Those
to
are
borrow.
expected. Yep.
So, right, that's the third leg of the stool is do people need to borrow to buy a house?
Yep.
So if you have boomer parents who are in their 70s, they have a $5 million stock and bond portfolio. They could pull $1 million out with the stroke of a pen, thanks to Morgan Stanley issuing them an SBL, and they can wire that money to their 35-year-old son or daughter to put a down payment or buy a house in cash. I
Hmm.
don't. Then I don't give a shit what you do with mortgage rates. It's not affecting the market. This
Yeah.
is the situation we're in the 20 most popular metropolitan housing area, the Schiller 20 city index. This is
Hmm.
what's going on. So and we saw a corollary to this in the S&P 500. You know their effective borrowing rate for a blue chip company in America actually went down last year. So the Fed funds rate went up 550 basis points from 0 to 5.5. And the effective rate that publicly traded large cap companies borrowed at actually went lower. They didn't need to borrow. This is not the S&P 500 of the 1970s where
Yep.
everybody was living on commercial paper and overnight loans and revolving credit facilities. These companies are stockpiling cash on their balance sheets faster than they can reinvest it. And so the same reason why raising rates didn't crack the housing market this time to the degree that a lot of people thought, we saw that same corollary. Why didn't companies slow down on buybacks, on hiring, on R&D, on capex? Because they didn't need to.
Yep. Yep.
Too much money, too much cash.
Fascinating take. Anything you can tell us about emerging markets?
No,
Like this chart, if you look at the purple, that is the return on emerging markets since 2014, which is
yeah, Terrible.
10.5%. Is emerging markets ever going to come back, Josh?
Look, I will show you emerging market stocks that have 10x'd in that same period of time.
Mm-hmm.
So this is not about all about country or region. And by the way, what is an emerging market? Because over this period of time, they became much more China. You know, China lobbied the index providers to make Chinese equities a larger part of their indices. It's a political decision, not an economic decision. And China then went on to have 5 years of horrific underperformance relative to other emerging markets, like, for example, India. So did the index providers do the right thing? I don't know. You've got political instability still in Latin America.
Mm-hmm.
Today we had a failed coup attempt in South Korea, which is in some emerging markets indices. Some providers have it as a developed market.
Mm-hmm.
Those dynamics never really seem to change. And so I think the right answer for investors is not what country do I buy, because I could show you technology stocks in all of these countries that have done incredibly well,
Yeah.
regardless of where they're domiciled. One really obvious example would be to look at Mercado Libre, MELI. This is the Amazon slash PayPal slash eBay, I think, of Latin America. And none of the stock markets, other than Argentina, have been rallying. But this stock looks as good or better than any FANG stock in America. So a lot of the dispersion of returns boils down to industry mix
Yeah.
of what these countries actually have making up their indices. And it's less about geography and more about industry. So
Okay. Yeah, it's a good take on things. Is there is no black and white. The emerging in general may be challenged, but certain sectors within emerging and certainly certain companies within sectors are things that there's promising
well,
returns.
look at ASML. Is it an English stock? Is it a Dutch stock? Is it a European stock, or is it a tech stock? Look at the last 10 years. I would say it's a tech stock. I
Yeah.
would not say it's a European stock, but
Yeah.
it happens to be based in the Netherlands.
Yep.
This is, I think, the way people want to start thinking.
Yep. Hey, Emma, can we quick put up the emerging markets? Just love to get people's take on, should advisors continue to be patient in awaiting the return of emerging markets, or should they shut the door?
I'm going to
Josh and
say
I obviously.
I'm going to say 60% continue to be patient. Let's say.
Let's see what it was.
You see how smart I am?
Pretty good, Josh.
Dude.
We're off by just 200 basis points, but that's pretty good. You should be a football bettor. Hey, let's home stretch this. I think we have a couple quick topics to talk about technology and wealth management. So, listen, a visual to aid the discussion of what is the role of AI in the wealth management industry?
I don't know. We are a late adopter of AI. I think it's something where there's no rush. I think it's something where advisors can take their time and see how things develop and let other people take risks with their client data, with their workflows, with their integrations. I love that we have these amazing companies coming out of the woodwork who are addressing all of these real life issues that wealth management firms face. And I think there will be some big winners. I also think some of the biggest winners will be incumbent large technology platforms. Like if you told me XYZ startup is going to be the winner in note taking on video calls, I'd say, okay, that sounds right. But then somebody else could come along and say, actually, no, it's going to be Zoom and Salesforce. They're going to have their own embedded AI tools, and there's no need to pay somebody else. So I don't. I'm the wrong person to give you a really strong point of view. I think these tools will ultimately become really important for profitability. I see them as more important for that than like revenue generation. Some of the ones I like are addressing the difficulty that advisors have in prospecting and finding new potential customers. I
Yep.
think that's a really fertile area for AI. So I'm bullish, but I'm
Hmm.
not like, oh, I'm the AI wealth management expert. It's too early,
Yeah.
and I'm not smart enough, and I just I'm holding back before committing
Okay.
to any of these platforms.
Yeah. And the approach we're taking at YCharts, as a software company, is I think we're less about trying to get ahead of things in making our software make investment advice for advisors. We're trying to streamline their workflow. Hey, you want to understand a fund with similar risk and efficient frontier characteristics and exposures as SPY, but it's missing the following characteristics. We think making that natural language and that automatically brings up a table and charts, that's the approach we're taking, is to just streamline the research process. But we're falling short of saying, hey, machines are ready to make investment decisions for advisors.
Yeah, I think that's right. Advisors are not looking for you to tell them how to invest. So
Yeah.
the last thing you want to do is solve a problem that nobody has.
Mm-hmm.
Look, I think there's like three things you could sell here. If you're selling AI tools to wealth management, we'll save you money, we'll save you time, we'll make you more handsome. Like those are the three things that people will pay for. If you
Mm-hmm.
can sell two out of those three, the first
Yeah.
two, I think you'll make some money. The tough part is a lot of the AI startups are building features. They think
Yeah.
they're building platforms.
Yeah.
It's really hard to build a platform. Advisors are not looking for more platforms. So we'll see. Like, well,
Yeah.
listen, I'm hoping I don't care who wins. I just want everyone to have fun. Is
Yeah.
that the right way to say it?
I think so.
Okay.
All right, let's conclude here. This is a visual put together by Bain, and the long and short is it's saying, like with the Maslow's hierarchy of needs, financial advice started with pushing product to sell product. Then it moved up into a 2.0 version, which is getting to know the person. The whole CFP profession came about to say, I need to know your life goals so I can pair that with an investment strategy. And then financial advice 3.0, I'd almost liken it to this
Wait,
Mayan.
stop. What is self-transcendence? It looks like somebody's soul leaving their body. Is that
Yeah,
the final
well,
stage?
yes. Well, listen, if I were smart enough to work for Bain, I would be working for Bain. Josh, I'm not smart enough, so I can't explain the upper tiers, except it's some Mayan transcendence where you just evaporate into the
All right.
clouds when you're
Sean,
that
we got
good.
5 minutes. Next slide.
No, but you
I'm
tell
sure
me
you
what's
had a great point here.
this is the last one, Josh, which is
Oh, okay.
do you see financial being a financial advisor, anything about the practice changing over the next 24 months? What advisors are looking at?
Yeah, so it's a good question. Everything changes, but nothing changes because the things that clients care about today, they will still care about in 2 years. The thing is, what you have to do, I think, at this stage in the game, is separate yourself from all of the competing services and firms that exist out there. For a long time, there was very little competition in our space. And I still think that advisors do better when they cooperate with each other. And that's why
Mhm.
we put on Future Proof and all the events and all the content that we do. So I'm not saying that this is going to become a blood sport, but I do think that clients' expectations are going up, and not just vertically, clients' horizontal expectations in terms of like the breadth of services that we offer are only going in one direction. And I think what we all need to focus on is, will my business remain competitive? Will my services remain attractive as the space gets more crowded and client expectations continue to go higher, meaning they expect more for the money they're paying. So we don't have fee compression in this industry. We have something different. We have margin compression. The fees are
Mhm.
about the same. I know advisory firms that are raising fees,
Mhm.
but what's not the same is what it takes to say, I'm delivering holistic wealth management. You have to be able to do a lot more than you had to 5 years ago. If you want to, if you want to bring on $10 million client households,
Mhm.
like you cannot do what you were doing in 2018. I mean, you could try, but someone else is going to come along and say, "Look at all the stuff I'm doing," and that's just look. That's it's the law of the jungle.
Yep.
There's always a bigger, badder lion somewhere out there. So
Yep.
I think people need to think that way, and it's healthy. What I'm describing is not negative. It's going to make you and your practice, your firm, better, sharper, because you had no choice. So happy Thanksgiving.
Yeah, and so let's wrap up, Josh. First of all, Josh, we're going to run out of time, so we're not going to be able to cover Hunter Biden. Not going to be able to solve geopolitical things. Sorry,
I had a Tabasco level take. All right,
you did. I'm sorry,
we'll do it
but
next year.
yeah, next year we will do that. In the meantime, I hope we gave everybody, with Josh's advice, some nuggets to think about for next year. If you're not following Josh, please do. I learned so much and have learned so much over the last 8-10 years from knowing Josh and following him and hearing his words directly. If you care to get in a conversation with YCharts, mention Josh's name. We are happy to extend a 20% discount to new clients.
Nice.
And that's what I would say. Josh, any concluding comments from you?
I want to say thanks to YCharts for all that you guys do on a regular basis for us as users, power users, and all the innovation. And I mentioned it on my podcast the other day, like how many things you guys have launched or improved in just the last 11 months of this year. It's been breathtaking. So I think on behalf of all the people who are here, who are current YCharts clients, let me just extend a thanks to your whole team, and we appreciate you. You help us do a better job for our clients, and that's gold. That's as good as it gets.
Thank you, Josh. So on behalf of the German and the Irish and Italian Browns, thank you guys for joining us today. Enjoyed having you, and you will receive a email of this webinar, and you can find it online too. Thank you, gang.